Why do people save money? How do economists think about savings? Economics can provide tools and insight to help you manage your personal finances. I'm Professor Chad Severson, and this is Economics for Everyone. Today we're going to talk about the basics of personal finance. That is, what underlies the purpose of savings and some basic finance concepts for saving optimally. What is the goal of saving? As an individual, your goal should be to maximize your utility. Utility refers to the benefits, satisfaction, or happiness that consumers derive from a good or service. When thinking about how consumers can maximize their utility over their lifetimes, it's important to take into account time discounting. Time discounting is the method of figuring out how much something in the future is worth in today's terms. For example, a dollar received 50 years from now may not be worth as much as a dollar received today. Economists think about personal finance and savings using a simple economic model. Like all models, this one makes some assumptions. One assumption is that individuals want to maximize discounted lifetime utility. Simply put, they want to get the most satisfaction over their entire life, taking into account how future happiness is valued today. We also assume that utility is generated from consumption, for example, consuming goods and services the individual buys. We assume that in any one period of time, there is diminishing marginal utility of consumption. That's a lot of syllables, but it means the amount of utility one gets from more consumption is lower when they've already consumed a lot. We also assume income is uneven across a person's life. Typically, it's low when you are young, high in the middle, and low again when you are old. And finally, there is some interest rate at which the individual can save and borrow. Interest rates are the cost of borrowing money or the rewards for saving it. Using this model, economists are able to make some interesting predictions. Individuals engage in consumption smoothing. Because of the diminishing marginal utility of consumption, they don't want large swings in consumption levels from one period to the next. Let's say you know you're going to get a dozen cupcakes every Monday. You're likely to spread out consuming those cupcakes over the week rather than eating them all in one day. This consumption smoothing desire is in tension with what are often big swings in income. The model also predicts consumers use savings to turn relatively volatile incomes that are not consistent over time, into smoother consumption patterns, consuming less than their current income when it's high, and consuming more than their current income when it is low. Another prediction of this model says if you receive a one-time unexpected gift of, say, $100,000, you spend very little of it right away. Your lifetime utility will be higher if you spread out the consumption paid for by this gift rather than spending it all at once. On the other hand, if your income unexpectedly rises permanently, then you increase your consumption roughly by the amount of the annual income increase. Now that we've looked at our model, let's talk about some finance basics. All of finance revolves around assets, that is, long-lived things that have value. There are many different types of assets, including cash, savings and checking accounts, stocks, bonds, derivatives, houses, gold, and human capital. All of these assets provide various returns depending on many factors. For example, if inflation is positive, cash will provide negative returns year over year. But a house built in a trendy neighborhood where everyone wants to live will see positive returns year over year. What actually determines the price of an asset? Economists look at three things. 1, the continued flow of benefits from the asset while you own it. For example, dividends that shareholders get from holding a share of the company, or the utility of living in the house. 2, the resale value of the asset in the future, how much you expect the house to sell for. And 3, the riskiness of the asset. Remember, discounting means future income can be worth less than the same amount of income today. Riskiness of income is a kind of discounting. Imagine investing in a young startup. Maybe it'll make a lot of money in the future, or maybe not. Risk makes assets less attractive, so holding expected returns constant, risky assets have lower prices. So, in order for investors to be willing to hold risky assets, the expected future increase in the price, that is, the return on that asset, has to be greater than that for less risky assets. Let's now look at another specific asset, stocks. When looking at the stock market, economists turn to the efficient market hypothesis. This hypothesis implies that markets incorporate all publicly available information into the price of a stock. This means prices change only in response to new information about the stock, and it is quickly and efficiently incorporated into the price. The efficient market hypothesis allows economists to make some interesting predictions about the stock market. Stock prices will follow a random walk. In other words, changes in a stock price are not predictable. Why? Well, if future price changes were predictable, the market would have already adjusted the current price to reflect those predictable things. Only things that are unpredictable today can affect changes in stock prices going forward. People or firms who react quickly and intelligently to news will be able to make profits from doing so. But unless one has private information, an investor will not be able to outperform the market. Meaning, for a given level of risk, the investor will not be able to generate a higher return than the market as a whole. All of this results in some basic rules for investing in an efficient market world. Hold a diversified portfolio. Remember that it's hard for you or anyone else to beat the market. Take lots of risk when you are young or middle-aged. Take less risk as you get closer to retirement. In general, you probably shouldn't be saving a lot when you are young. That's the permanent income hypothesis. But one exception is you should participate to the maximum in retirement savings plans that are subsidized by your employer. And as long as you are saving, do it in the most tax-favorable way. Economics provides tools and strategies to best maximize your current and future financial success, because economics is for everyone.